DSCR. So, what is a DSCR loan? A lot of lenders advertise this, but there's a lot of people out there, a lot of realtors and clients that are just unfamiliar with it. Well, DSCR stands for Debt Service Coverage Ratio. And this type of loan, this debt service type of loan, is basically for investors that are looking to purchase a property, and the rental income from this property has to at least service the debt. So, in other words, it at least has to equal the amount of the debt. So, these are popular in the commercial world, but not too popular in the residential market, but it's gaining popularity. A lot more investors are utilizing these type of loans. So when I say it has to service the debt, I'm going to give you a quick example. So if someone's purchasing a home, an investor's purchasing an investment property, they're putting 20% or more down. Let's say their monthly mortgage payment, including everything, taxes, insurance, any HOA dues, let's say it's $4,000 a month, right? So that means in order for this property to debt service at a 1-to-1 ratio, the projected monthly rental has to be at least 4,000 as well to match their mortgage payment or higher. The higher the better. So a debt service ratio of 1.1, 1.2, 2, 3%, that's all great. That's all, it at least hits that minimum of 1. Now, if it comes in under, if you're, let's say that same example, payments 4,000, but the projected rental is only 3,500. Well, that could be an issue because now the projected rental doesn't service the debt. The debt is actually more than what you can get for the property. Now, not to get too complicated here, but in some instances on a debt service loan, we can go over a 1% ratio. We can go sometimes down to 0.85, but it gets a little complicated. Usually it's with, higher credit scores, larger down payments, et cetera. Because if you think about it, it's a little bit more risky, right? It's not servicing the debt. But you really, the easy way to understand this is just to at least be at a 1-to-1 ratio. So that's why I tell some people, investors, when they're doing a debt service, it's really going to depend on that projected rental to determine how much you might have to put down. Because let's say you come in and you only want to put 20% down, and that payment's $4,000 a month, like I said, but the projected rental is $3,500. Well, you might have to put 25% down or 30% down to get to that projected rental. And the projected rental is determined by the appraiser. The appraiser will go out there. He'll not only appraise the property, but he'll also look at the surrounding area, see what places are renting for, and he'll come up with a rental amount too for that property. If the property's already currently being rented with a tenant in place, then of course, then we would just use that exact rental amount. But if it's not, you can still do a DSCR loan by using the projected rental from the appraiser. So that's a DSCR loan. The advantage of these is that the investor does not need to worry about income verification. So tax returns or bank statements or any of that, they do have to source the down payment. So the down payment funds have to be properly sourced in season like we would on any other loan. But the big advantage here is they don't have to worry about income because we are strictly going off the debt service ratios based on the appraisal and the rental portion of it. If you have any questions about this, feel free to reach out. Hope you have a great day.